Okay, hopefully this will be our last video for today. Let's go back on the adjusting entries. We did post this last one, and let's go post this $1,200 utility expense and utility payable. So over here, and we've got 1231 and utility expense of $1,200. That's going to give it, an ending balance of $1,200 as well. And then go back to utilities payable, find it, and post our credit of $1,200 for there as well. And again, when we draw our line, that will give us an ending credit balance of $1,200. Okay, so let's go. Got a thing I'm having to work around is make it awkward moving. So let's see, what have we recorded so far? So we have recorded supplies, and then we still have prepaid rent and unearned revenue. So I'm going to go to those accounts, and we'll figure out their adjusting entries by looking at them. So prepaid rent, and this is going to be transaction C. So if you were to reference it to your problem information, supplies was D, prepaid rent is C. So notice we paid $3,600. So for C, we paid $3,600 on April 1. So if I count, that was for a whole year. So for a whole year. So April through December is 9 months out of 12 months. That's $2,700. Or if you can do it in your head, 3,600 divided by 12 is $300 a month. 300 times 9 months is 2,700. So we need to expense $2,700 of that. So we want prepaid rent to go down $2,700, right, on 12/31. And when we make that journal entry, that will change this ending balance to $900, right? And that is 3 months, right? At $300 each is $900. So we need a journal entry. I'm trying to draw a line there. 36 minus 27 is 900. So let's go make our journal entry, right? We want the asset to go down with the credit. And remember, expenses go up with debits. So the expired rent, we will have rent expense. Remember, expenses are debits. Go back to your debit credit rules if you need a refresher on that. So debit rent expense, credit prepaid rent, the asset, $2,700. And notice both sides of the accounting equation are going down. Assets go down, stockholders' equity. Let's finish with that post. We already did the prepaid rent credit. Let's go to rent expense. So rent expense, $2,700 on 12/31. Add up rent. We're going to get an ending balance, $2,700. Okay, and then the last one that we need to make an adjustment for, and it's going to be B in the problem. So B, C, and D. A, as you recall, was this unpaid bill for utilities. So it was this one for utilities. We got a bill for utilities. We debited utility expense, credited utility payable. Okay, so we're going to do B. So doing the calculation there, we received written cash in advance for services we haven't provided yet. That was at very beginning of February. So 11 out of 12 months have gone by, right? And it is $200 a month times 11, $2,200. We have earned $2,200. So we need to reduce this, $2,200. I'm going to make an adjusting journal entry on December 31st, and then that will change the balance from 24 minus 22. Now it's going to have a $200 balance. That represents 1 month left, right? So $200 a month, right? 24 divided by 12 is 200. So I want an ending balance of $200. All right, so we need to debit the liability. Debits reduce liabilities. Debit at $2,200. We provided services, so that is revenue. So let's go and fill out our last adjusting journal entry. We are going to debit unearned revenue, which is a liability, cause it to go down $2,200, excuse me, and credit service revenue. Revenues are credits. Go back to your debit credit rules if you need a refresher on that. Okay, so because we provided the services. Okay, we've already posted the debit. Let's go post the credit to service revenue. So over here, $2,200 on December 31st, and that's going to change our ending balance to $13,200. So now I have an ending balance, $13,200. Okay, so that has changed some of the balances. So let's go look and see. Cash, accounts receivable are the same. Prepaid rent now is $900 and supplies is $400. So we're going to have another trial balance. I just put them side by side so they would be easy to do. So cash stays at $1,500. Accounts receivable stays at $500. But remember, our prepaid rent went down to $900. Supplies went down to $400. And I'm going to go ahead and tell you nothing happened to land. So those are the new balances after adjustment. So adjusted after we made those adjusting entries. Here are the new balances. All right, land stayed the same, and here's utilities payable, accounts payable, and unearned revenue. Those are all credits. Let's go put them in. So utilities payable has a credit balance of $1,200. Nothing happened to accounts payable, but unearned revenue now is only $200. I'm going to tell you nothing happened to notes payable or common stock. Those stayed at $2,000. So these are just this is before adjusting, snapshot. Here's click, after adjusting, snapshot, what these look like. And retained earnings will be 0. Okay, so second page, again, note payable, common stock didn't change, retained earnings stayed there. Okay, dividends stayed at $1,000, but revenue went up to $13,200. It's a credit. Dividends stayed at a debit of $1,000. Service revenue is a credit, and it went up to $13,200. Then we have our expenses. Salary stayed the same. Operating stayed the same. Utilities expense now has a balance of $1,200. Those are debits. And then now utility expense, $1,200. And then the last two, rent and supplies, ending 27 and 100. So I want the very ending balances. And we're going to draw our line again, and I'm going to add up all the debit column. So everything in the debit column is $21,400. and I add up the whole credit column, and you should also get 21,400. Okay, then last thing for today is this is what we will write our financial statements from. So we will prepare our financial statements from these columns. So you can see it's going to be kind of easy. Cash. Here's our balance sheet. But we don't start with the balance sheet. We're going to start with the income statement. Right, so that's the first thing we prepare. And then second thing is the changes. So the changes in stockholders' equity is the second financial statement that gets prepared. So we're going to use this revenue, these expenses. Remember, dividends. Dividends do not go on the income statement, only revenue and expenses for now. Revenue and expenses go on the income statement. Here are our stockholders' equity account, and of course, dividends is the change in retained earnings. And then we'll come back to these balance sheet accounts and use these numbers, but we are going to end up with a balance in retained earnings. It will not be zero. Okay, we already did the financial statements back in chapter 2, and I actually just printed them out for us. So go and you can see, right? Revenue was 13,200. Notice I give the time period for year ended. Here are the expenses. Add them up. I get net income. Changes in stockholders' equity also is for a year ending December 31st. This is the first year, so zero balances. Remember, our net income flows into retained earnings. Then we subtract the dividend and get ending retained earnings, and then we can add those together. These ending balances for common stock and retained earnings go forward to the balance sheet, the 2,000 and the 2,300. Right, here they are. So I put them on the balance sheet, and then all the rest of these were just pulled. So notice we did not have a zero balance for retained earnings. We've updated the balance because there was revenue and expense and then a dividend. So it's been updated. Next week we'll look at, well, it's still zero in the accounting system. How do we get the balance to 2,300? We will solve for that next week. Okay, I think that's it. I hope that your homework goes well, and I will see you next week.